It was good. It was a 3-day holiday in hospital. It was good. It'll learn me for splitting broken axe heads.
Okay. It is 3 o'clock. We are now live for our interview. Welcome and thank you for joining us. Let me introduce Bruce and Michael, team at Gilligan Shepherd. For those of you who don't know Bruce, we will try to keep him on track, as this is a live conversation with no editing. Bruce, how is that going to work for you?
Probably badly.
Yeah, probably what I thought as well, but let's try. And I have now apologised to the viewers.
Thank you.
Okay, Michael, you've written a couple of articles.
Mm-hmm.
The first one covered mining, free money, and rocket science. And the second one was about bridging the gap between science, entrepreneurship, and capital. We received some great feedback on those articles with some questions as well. So well done to you. And we just want to follow on from those articles. Our topic today is economising your way to success. Michael, can you please give us a brief summary of what you wrote in your articles? And before we start with any of the readers' questions that we'll have for you.
Sure. Thanks, Deborah. So in essence, the premise behind those articles was, as we've seen, lots of early stage companies manage to develop concepts. They've raised early amounts of capital, but they've really failed to kick on. We've seen, even just recently, the survey from the Angel Association that validated the same thing. Early stage companies can get a little bit of capital. They tend to delay doing a lot of the really important stuff in the hope that the next investor will pay for it. And I think what that's created is a whole lot of companies that just fail to kick on because they haven't been able to attract enough capital at the early stage to invest in the right sort of people or the right sort of resources to get it to that stage, whether it will fly or die. We see a lot of early stage companies that don't really know or are not in a fit state to really be raising more capital because they haven't had enough to get to that point of validation early on. And that sort of led us to that view that this economising our way to success just won't work.
Okay. Bruce, do you agree with that? And do you think that's also why this is so hard for SMEs to get funding?
It's not so much that SMEs struggle to get funding, it's that certain founders do. Having been involved with numerous startups over a long period of time, including many founders, there is a universal syndrome called founders syndrome, of which one subset of that is the founder's desire to retain control and avoid dilution. And that really doesn't change until the founder stops focusing on his percentage in the company and starts focusing on his share price. And that tip over point between dilution and raising capital and focusing on the value of the business is a fair way down the path. But the consequence of founders wishing to avoid dilution means they wish to crank their value up initially beyond that which is sustainable and avoid raising capital that is necessary to create the value that they wish to get. So to Michael's point, yes, there is an issue here. It is a universal truth that founders will always under-raise at the beginning, they will under-invest at the beginning, and they will hope that with luck and a fair wind, the minor investment capital round that they've raised will create the value for an up round next time, and hope isn't a business strategy. There is also among boards, particularly boards populated by investors and dominated by investors, a reluctance to acknowledge failure and a reluctance to do a down round. So you have a situation where the founder at the beginning wishes to raise as little cash as possible to avoid dilution. and you have investors that refuse to acknowledge failure, which is very common, and boards that won't tell their investors that they've failed and won't do a down round to make it succeed. So those human constraints are probably the major contributor to 30% of failures. The rest are just dumb ideas.
Do you think that founder syndrome is perpetuated by the fact that, compared to the US, certainly in New Zealand, founders are almost starved of their ability to live, and they are promised, a smaller piece of a bigger pie is going to be your reward. So therefore, during the early stage, they're not given enough capital to really drive the business, with this promise that it's going to be great down the track. And any, to your point, and any failure along the way is going to see a down round, diminishing of value. The size of it, or the value of the pie for that founder, becomes smaller and smaller as they progress.
That is the American way, right? The New Zealand way is the founder is put on starvation rations, often beyond and below the level they need to live. And the sweetener is, well, you have retained a bigger share of a really little pie. And what is sold to them is your share will not be diluted as much as it would be if we raised capital to pay you. Okay? The better model, which I think is the American model, is pay your founders what they're worth and have them invest what they can alongside you with cash. It's not that tax efficient, but it is a different model. The American model is to focus the founder on having a smaller share of an enormous pie. The New Zealand way is to focus people on having a really big share of no pie.
So one of the questions we did receive from one of our readers was, do you think New Zealand should have an SME institute?
Do we need another state-funded quango that spends their time jaw-gnashing the tyranny of small business with no end outcome? There is an institute of this, that, and the other in New Zealand. We have endless talk feasts. No, we don't need another talking group. Unless Paul Henry's running it, then it could be entertaining.
Yeah, I agree. There are enough agencies now that are dedicated to growing and developing, science, this, science, that, early stage businesses, and none of them actually deliver any value to those companies that are at the coalface trying to grow and develop a business.
So then, do you think it's possible to start an SME accelerator that operates at a small profit or break even without government funding?
Without government
Yeah.
funding? Well, certainly the government-funded ones have been a mixed bag. I'll let Michael talk about that because I have a particularly jaundiced view of them.
Talk about the government ones.
Is there a commercial model that could make sense in a combination of the various accelerators and the various BIF-based trade and enterprise funded stuff? Is there a commercial model in there?
Not with what we have now. I think if you had a commercial-based accelerator or incubator, whatever you want to call it, that had a far better qualification and identification process of early stage companies, then yes, there's no reason why that couldn't be a commercial success. The problem with broad brush generalization, the existing incubators now, is they have an incentive to bring every man and his dog and his idea into their fold as long as they can generate fees either from the early stage investors or the government, as opposed to a commercially based one that is more focused on a better stage and better quality ideas, ones that have actually got a better chance to make that breach from R&D to commercialization to exit. If there was the right discipline and rigor around those. Yes, I think there is a commercial model, but that there is no apparent discipline and rigor about the current incubators that we've seen over the last 10 years.
That's true. And of course, you've also got the established family offices in New Zealand that attempt to do that, Michael. And certainly K1W1, Stephen Tyndall's VC entity, has probably done a reasonable job of picking winning horses, would you say? So there is clearly a commercial model there if you're patient and you can fund intelligent filtration and proactive management, although K1W1, to my knowledge, aren't proactive managers of startups.
I think they've probably done a good job of identifying who are the better filters of opportunity.
That is true.
I think they've seeded enough. I obviously don't want to speak about detail, but they funded well over 200 early stage enterprises, and I'm guessing you could count on one hand the ones that have been successful by any stretch. I don't think they, from what we've seen, they will invest in it. They've invested in a whole range of different opportunities presented to them by different intermediaries. Some have flown well, some haven't. Taking almost that spread bet across the economy. I think it comes back to that whole point of being able to better identify candidates for early stage investment and giving them a little bit more upfront to allow them to do things earlier than later. That number 8 mentality of we'll just get by on a wing and a career, starvation rations, hoping to get to that point of a funder to come in and backfill everything we should have done. But hope is not a strategy.
Yes, it is typical to underfund on the first round, and angel networks tend to guarantee underfunding. And they also tend to guarantee that your funders don't have connectivity or drive with the business. But what you're saying in terms of a commercial model is the key elements are spread your risks, double down and concentrate on sensible risks. The ones that have legs, fund adequately. Ensure that the network or the funding tree deliver the necessary support, mentoring, connectivity, judgment, whatever. So active investors. And ensure that you have really good filters at the front end to filter out the dross, so you don't waste too much time spinning tires.
Correct. And spending little bits of cash.
Yeah.
That could be better spent on follow-on funding or giving somebody a little bit more initial funding to advance them faster.
So is that not in part the VIF model? What's failed with VIF?
How long have we got? But I think the reality. I think the reality with VIF is almost is almost the fact that they co-fund alongside other people or other aggregators or people who bring them ideas. The ones. They will.
But that is the filter.
That is the filter, and I would argue that filter probably needs to be a little bit sharper or a little bit better equipped to identify those opportunities who've got better opportunities.
Okay, so the quality and the incentive of the filter is important.
Correct.
The judgment of the manager is important.
Yes.
And the courage to double down and back those you think can win is important. And the clarity and honesty of thought to stop is important.
Exactly.
So those characteristics would give a fund of startups a better chance of success.
I think in short, yes. And I think some of the changes that are coming through this now is that they are actually starting to demonstrate that courage and being able to invest in those companies they think have got legs. But the challenge they've got is that they can only, some of the way they've been set up, is they can only fund or follow on fund if the original partner funds as well. Now, if that original partner doesn't have either the capacity to follow on, that leaves VIF in a situation, and we've seen this a number of times, where they want to follow on, but there is no ability from their partner to match funding, which means they cannot fund.
Going back to what are the barriers to having an entity for profit that seeds startups? Is it skill set, Michael? Is it skill set, attitude to risk, attitude to failure? What is in your view, the cultural nuance that has not allowed this to emerge in the context of New Zealand to date?
Good question. I think all of the above is what's missing. I don't think there's one silver bullet in terms of either attitude to risk or skill of the manager. I think if you look at the early stage landscape here, there is so much unhelpful competition about who's identifying the opportunity, who's going to be the lead partner on raising the capital. And I think it almost becomes a competitive game about who's going to be taking this to VIF, who's going to be taking this to K1W1, as opposed to actually identifying and getting different, for example, the universities or incubators to actually work together to identify what's going to be the best for this particular idea or opportunity. I think specifically the attitude towards risk and it needs to change, but I think they need to have a better understanding of what the opportunity is and a better understanding of what it could be, so they can then address is this opportunity really worth pursuing, or is it just too risky? I think again the evaluation and qualification stage needs to be spent in terms of time and effort by those qualified to look at the opportunity.
Okay. Sorry, some of you haven't been able to hear some of the questions that I've been putting to Bruce and Michael. I hope by raising my voice a little bit that this helps. We also have viewers that have the ability to ask questions, and we will answer those questions if you type them in. We'll get Michael and Bruce to answer them live. But one of the other questions is if we think about SMEs, what do they actually need to get started? What sort of applications? What is the basis that they want to actually start to think about an SME business or an idea that they've got? What do they need to get started?
Me first?
Yep.
Okay.
You first.
The first thing they have to do, this is any SME or a tech startup?
I think it would be any SME, anyone that we actually would have as a client that would come in and actually have an idea and want your opinion.
It's the first thing I think they need to be able to articulate very clearly to an advisor, a banker, a lender, an investor, or a customer is a customer value proposition. What is it that I'm going to offer to a customer? Why is it that this customer would want to buy it? And what value, which isn't money, what value do I deliver to you who are paying me money as a customer? If they can't articulate a market value proposition and a customer value proposition, they're not at the start shop. Second step after that is they have to have a unique proposition or a unique market opportunity that gives them a competitive advantage. And they have to be able to articulate what it is about them that is different, that a customer would choose to buy. They also have to have a brand story. Why buy from me? Why do I do what I do? What's important to me? What's my story? Why do you, as a customer, choose to deal with me? So they need to know that. They need to be satisfied that whatever it is they're selling, they can sell for $1 and buy or create for less. Because if there is not a profitable opportunity, the business isn't sustainable. And they have to have a clear plan on how they will launch and distribute and get this product to a customer and how they will communicate and reach customers. Without those clear thoughts in their head, they are not at the start. Beyond that, then there's a whole bunch of other stuff that follows.
I agree with you. And the only piece I would add further to that is one of the things we hear often is, this is the problem I'm going to solve for this particular customer. The piece I think that more often than not is missing is when you're talking to that customer, what is the cost of not solving that problem? You've done a great job, Bruce, of identifying this problem, and it's going to cost me $1 to fix that problem. I go, wow, that's fantastic. But the cost of not fixing that problem is business as usual, and it doesn't actually matter. And I think it's all well and good that somebody has come up with a great idea or a great solution to a problem. But if that problem is not worth solving economically to a customer, what's the point? You are basically trying to force them to solve a problem that they're quite happy to live with.
Or they don't know they've got. In which case you're saying to them, have you got a problem? And they'll say, no, I haven't. Well, you have. No, I haven't. There's nothing worse in terms of starting a business than having to create a market to satisfy. And some startups have to create the market in order to satisfy it. It's hard enough launching a new mousetrap without convincing homeowners that mouse are problems first. Why do I need to catch that mouse? Well, because it's vermin. Why is it vermin? In order to get over that, to sell them a mousetrap is just a bridge too far.
Yeah. All right, you need to repeat the question that I asked you because they can't hear you. You don't know why, because I'm close to the mic. That's right. Anyway, so the last question is these were written before budget, so has anything changed since budget?
So the question is, has anything changed since the first Labor budget? Was there a budget? Did they do anything that impacted on anything?
Our viewers know that they can't see questions.
I don't think anything's changed except that fundamental uncertainty continues as it did post the election, and it is now probably harder to convince people to start something, execute on something, or move cash from one pot to another and take risk than it was a year ago. That's entirely predictable. It'll clear, it just might take a while.
I think if you look at the polls, they're saying that business uncertainty is at its highest level since before the GFC, which may or may not be true. I think in terms of the question, the budget, I think there was obviously Shane Jones' $1 billion regional spend up. Like anything, that will be a 2 to 3 year plan before you see any roll-on effect from that, I suspect. In terms of a real difference, certainly to the early stage space, unless they are tinkering with Callaghan R&D tax grants, VIF funding, I don't think in the early stage space there it's certainly any better or easier than it was before.
But equally, it's no worse.
No worse. Yes, I agree.
Okay, we haven't had any questions from the viewers. So if you guys have got anything you can finish with, and then you can just read that out at the end when you're ready to close. They can't hear me.
Okay. Any observations?
Any observations? Should we talk about angel networks? Another one of my pet hates.
Go on.
Are any of you members of a Rotary Club? Rotary clubs are at least honest. They raise money for charity and they're a nice community. Angel networks, however, do the same thing. They rattle a tin cup around, raise some money for the latest startup, clip the ticket for themselves, to Michael's point, to feed their animal, and everyone goes home feeling they've done God's work. The company doesn't get enough money. They get a wide spread of shareholders, usually held through a nominee company, and no one is adding any value. Please, please avoid angel.
I mean, it's not all doom and gloom in terms of the early stage space. I think if there are plenty of good ideas that will be backed by some good science, good intellectual property. I think if there starts to develop that discipline and rigor about the identification of these and the support of these ideas to take them from R&D to commercialisation, I think there is still plenty of good opportunity, and we're not back to picking apples and selling them on the side of the road.
Or out of the back of the truck.
Or out of the back of the truck. Right, indeed. In terms of that,
what's changing? There are more emerging funds that are domestically based that are attempting to move the dial, so there is hope. Those funds generally are carrying sidecar investment rights. What that means is the funds actually have in them a group of people that can act as a filter. They have a pile of money that can act to procure the opportunity for that fund and its own investors. And you have scalability beyond the fund to the wealth and resources of the people that have invested. That is a really neat new trend that has started to emerge in the last 3 or 4 years. Some of them are focusing on mid-stage venture capital, such as the Movax of this world. Others are a little earlier, such as Puna Koike and Lance Wiggs. And some are even earlier than that, well, actually across the spectrum, which is the Impact Enterprise Fund and the new Matu Fund. And there are endless other ones out there. The point of these funds is it provides a bunch of people within each investment management group with a pool of resources to actually do the necessary due diligence work to establish that certain startups actually have legs and are worth investing in. And then each party behind those funds can invest what they wish. One other emerging trend is a little more innovation around how managers are rewarded. Past models based on the Israeli model have distortions in them. So there is a growing, albeit still embryonic, maturity emerging in the VC and private equity market in New Zealand.
But question, Bruce, if you're an early stage company and you've got a choice between 2 funds and 2 local funds, much in the muchness, and one is saying our advantage is that we've got great connectivity to US-based VCs or Asian-based VCs. What is your take on that, and how and what evidence have you seen that these connections to these international VC funds have actually delivered value to New Zealand-based startups?
I would not and ignore it on the basis that mostly US-based VCs are slow, ponderous, and difficult to deal with. They have immense resources available to them and display extreme caution in deploying them. The deal time in dealing with a US VC is anywhere between 6 and 12 months between first presenting a deal to them and getting them to close. For most startups, 12 months raising capital kills them because they're not focusing on the business. In terms of picking a fund to become your anchor investor if you're a startup, it is no different to any other commercial decision you'll ever make. You will choose a fund that is led by and has people that will be engaging with you, that you feel you have a connection to, that you feel you can admire and trust, and that you feel will deliver either technical, connectivity, network, market, or other value to you beyond the money they're giving you. If you're not getting that, you may as well get your money from somewhere else. Because all money has no conscience, it has no ethics, it has nothing. People have that. And when people come with money and values and beliefs and connectivity and energy and an enthusiasm for your product, you get value leveraged beyond money. So pick funds based on the quality of the people and the management, nothing else.
Right, I think,
Great.
I thought we were going to be ending up disagreeing on stuff, but clearly not.
So let's find something we can disagree on.
Maybe that'll be the next time. So just
we'll have something. We've got to have something we can disagree with. Pick a topic that you know I'll disagree with you on. No, please.
This live stream will end shortly. You can view it again from our website, the Gilligan Shepherd website. Please keep the feedback and questions coming, and we will be up at some stage with another live conversation, details of which will be in our newsletter, which will be out very shortly. Thank you for tuning in. Thank you, Deborah.
Thank you.